Hey traders, today is Tuesday, June 23rd, and I'm Michael Boutros, Senior Market Analyst with StoneX, here for a quick multi-time frame look at the Japanese yen. So the intervention threat is ever present, and dollar yen is breaking to fresh highs here, testing a resistance level near the 2024 swing high. You're looking at 161.95. The breakout we've been talking about for the last 3 weeks was at 160.29 into 160.73. You're talking about the 2024 high week reversal close and the close highs that we registered earlier this year in March. Now, we broke through that last week, and that advance is now extending into that 2024 swing high. We're looking for a reaction there. The trade remains constructive, even from a momentum standpoint. The momentum still has the favor of the bulls, but you are facing that intervention threat. There were comments or reports that Secretary Treasury Bissent was speaking with the Japanese officials as well, and that they're looking for possible coordinated intervention. So the markets are still on edge. Nonetheless, the trade remains constructive. Here's what it looks like on the daily chart. Now, we're in this near-term channel just off the May lows. You could see that channel resistance converges right on the 2024 high and the 2024 high day close. That gives you 161.68 into 161.95. That region right there has been capping the advance for the last 3 days. Look, we've been up 6 out of the last 7 weeks. It's about 4.4% just from the monthly low, and we're at this major hurdle in price at this lateral level. Here's what it looks like on the 4-hour chart. This is the same pitchfork we've been tracking for over a month now, and the 75% parallel now further highlighting this immediate resistance. Again, 161.68 into 95. The weekly opening range is taking shape just below that. If dollar yen is heading higher on this stretch, pullbacks would need to be limited by 160.36 into 160.73. Again, that's the 2024 high week close and the 618 extension, okay, from the advance off the lows that we registered back in January. So a very good pivot in price. It was the highs that we registered back in April. It was the origin of this most recent breakout. That's the support that would need to hold if we're heading higher on this stretch. A close above 161.95 is needed to mark resumption, and then you're looking for the potential topside targets into 163.33 and 164 proper. 163.33 is the 1618 extension from the advance off the April lows. Okay, let me take you a little bit back further here. So you're talking about 1, 2, 3 from last year. 164 proper, that's just the 1618 extension of the range breakout of this fiscal year, right? So the levels are pretty clean. You're still threatening that intervention play at any point, okay? And one thing to keep in mind is that the markets are heavily stacked. If we look at the client sentiment in real time, our client base is slated at 8% net long, which means a 92% net short positioning hold. So that is to say that retail is extremely net short on this position. And if that trade continues to rally, the trigger to close out those stops is going to be another buy order, which could further propagate the top side. So use some caution here. Obviously, again, the trend from a technical standpoint is constructive. We're up against resistance. The weekly opening range is taking shape right below, but that intervention threat remains ever present. So constructive from a technical standpoint, while above 60.36, need a resistance break above 61.95 to get resumption. Topside level, initial resistance would be 63.33 on a breakout. We still do have some PMI data out of the US later today, but the big major event risk for the week is going to be Thursday's personal consumption expenditure. The Fed's preferred inflationary gauge is expected to show another uptick in inflation from 3.3 to 3.4% on the back of the recent Fed decision and the updated SEP, which showed them greatly upwardly revising the expected inflation run for 2026. This is going to be critical for the Fed outlook. As it stands right now, market participants are still pricing in roughly a 74% chance the Fed's going to have to move as early as September. So certainly the backdrop for the monetary policy outlook will be critical as we head into that inflation report in just a few days. We'll try to keep you updated as always on MB Forex on X. Till then, best of luck trading. We'll see you tomorrow. Cheers.